Hey, Jason here. Today's video I'm going to answer the question, should you invest in EXAS Sciences stock for stock ticker EXAS. This is an investment analysis for Ethan the Warender. Hopefully I'm pronouncing that right. Thank you for requesting this, Ethan the Warender. Again, hopefully I'm pronouncing that right. And before I get to the video though, I didn't let you know you can get this video as a podcast anywhere in the world for free on all major podcasting platforms. Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this part of the I Love Value Investing podcast anywhere in the world for free. And if you like this video and our other videos, make sure to subscribe and hit the notification bell so you're notified every time we release a new video. I release new videos all the time. Okay, if you've seen any of my other videos, I apologize for this. I don't want to do this, but I have to do this because every time I forget to do it, I get nasty comments. So this is for informational purposes only. This is based on my preliminary analysis checklist, which I'll tell you how to get for free later in this video. This is my personal thoughts on the company based on my criteria for my investors. I do not short sell ever. So any stock I talk negatively about, I don't profit from. I do not own stock in a long position in any stock I talk positively about. These are at the request. These videos are all for the last 2, 3, 4 months at the request of viewers. Most of the time I don't know anything about the companies that are researched. Some of the times I do. Even though, or in that case, in all cases actually, I don't care about the company's story at all. I don't care, or at this stage specifically, I don't care about the company story at all. I don't care what it says it's going to do. I don't care what the CEO's plans are. I don't care where the CEO worked before. I don't care about any of this until much later in the analysis. A company has to reach my threshold at this stage to even consider that stuff later on down the road for me and, again, for my investors. Why should you listen to anything I have to say? Because in the first 9 years of my career, I produce average annual returns in the portfolios I manage of 23.5% per year. This puts me just behind the great Warren Buffett in the first 9 years of his career, where he produced average annual returns of 24.2%. I'm not saying this to brag. I'm just saying, or telling you this because to prove to you that I actually know what I'm talking about a little bit. So, again, I apologize for that. But I have to do it because every time I do not, I get disgusting comments. So, let's get to today's analysis. Again, this is for Ethan the Warender. I checked that several times. Hopefully I got that in there correctly, but I checked it several times, so it should be. Okay. EXAS Sciences Corp, stock ticker EXAS. I have never heard of this company before. So this should be interesting. $18 billion market cap. 11 price to sales. I don't care about price to sales ever. But this is a relatively high number for price to sales. This is also a sign the company is probably not profitable right here, which is another sign the company is likely overvalued. Okay. EXAS Sciences Corporation, headquartered in Madison, Wisconsin, provides cancer screening and diagnostic test products in the United States and internationally. EXAS Cologuard screening test, a non-invasive stool-based DNA test, is a pre-cancer screening test for colorectal cancer. Company only competes in the precision oncology market. I'll go back to that in a second. With Oncotype DX, a genetic-based treatment selection test for breast, prostate, and colon cancers. With the acquisitions of Base Genomics and Thrive Earlier Detection, EXAS is building a multi-cancer early screening test to detect over 14 cancers. A test that would be one of that's a mistyped sentence, which is why I'm struggling. A test that would be one of the earliest entrants in liquid biopsy blood-based cancer screening. So, why I want to go back to precision medicine or precision oncology here is because A, this is fascinating and amazing and world-changing stuff. Precision medicine has different definitions for different people and different companies depending on what you're looking at. But in general, it's using genetics and CRISPR technology in some cases to completely eliminate diseases in some cases, completely eliminate medical anomalies, chromosome issues. I don't know if chromosome issues are in there. What are some other things precision medicine does? Hopefully you get the idea. These can also be used in this case. Most likely it's being used for early testing. So for example, let's say you have a family history of colorectal cancer. You could get tested based on Exact Sciences precision medicine stuff here that they're talking about, and you could be told that you're at a higher risk, lower risk, whatever, for that kind of cancer. Eventually, the theory goes that if you do have a genetic predisposition to these kinds of things, again, let's say colorectal cancer in this case, you could down the road have your genetics improved, change. I don't know what the proper terminology is, spliced. I don't know what the exact proper terminology is there, to decrease your risk for that kind of cancer. Again, in this case, but this is being done for everything medically at some point to some degree, and it's fascinating. Personally, I find this stuff fascinating. Also, something to watch here that caught my eye is they're not just doing this genetic medicine now for the colorectal cancer. They're doing it for 14 types of cancers. So this could be a huge competitive advantage for the company down the road. Sorry, getting a drink of water. Down the road, if these tests work and they work well, this is most likely patented, trademarked, copyrighted, whatever. So this could be a huge competitive advantage for the company as well. Another thing I wanted to highlight there. Okay. Their revenues have exploded. Okay. So they've gone from $4 million in 2011 to $1.6 billion rounded up in the trailing 12-month period. That makes sense because precision medicine has only been around for 10-ish years, and that's kind of being generous at the beginning stages of everything in a real sense. Precision medicine, testing, FDA approvals, all that stuff has only been around for a few years, I think. So that explosion in revenues makes sense. That's still insane. I'm actually at such high growth rate. I'm actually going to calculate it out. 1,546 minus 4 divided by 4. That's 386x increase in revenue in 10 years. That's incredible, frankly. Because a lot of these companies are still relatively new, they're still losing a ton of money because they're putting all of their money that they do earn back into the company, which is why you see hugely negative operating profits here, and then hugely negative operating profit margins. I look for anything above positive 10% on a consistent basis. So while this is not a surprise that these are negative, because again, they're putting all their money back into research and development and patents and lawyers and all that stuff, it's still not a great thing, obviously. Earnings per share negative. In part, they are issuing shares, a ton of shares, about 103 million shares in the last decade, to fund this growth, because obviously they're not making money from their operations, or they're losing money in total from their operations is a better way to put it. So they have to fund those operations, those developments, those lawyers, those trademarks, all that stuff going forward. So one way they do that is to issue shares. This is interesting. The book value per share has skyrocketed too. From $1.14 per share in 2011 to $21.27 per share in the trailing 12-month period. This is a great thing. Can be a great thing, because while book value per share doesn't matter as much as it used to, it's still a somewhat decent proxy of the trend of the underlying intrinsic value of the company. This trend shows that the underlying intrinsic value of the company is skyrocketed over time. There is a caveat to that, though, which is why I had the kind of awkward pause and laugh at the beginning of this section, because I saw back here that they, where is it? They bought a company, I'm pretty sure it said. Okay, we'll get back to that later. But they bought companies in this arena. So we will find out when we go to the balance sheet if these were good acquisitions or if this is from goodwill. We'll get to that later, though. Let's keep going on this. Free cash flow is negative as well, except for in the 2020 full year, and then in the last 12 months, free cash flow is actually positive, which is a bit of a surprise. So we'll see if that's from debt. Further along, it's partially from the shares, settlement shares. We'll see if it's also from debt as well. ROIC is hugely negative. Again, not a surprise, but not a great thing. I look for anything about positive 10% on a consistent basis. Free cash flow to sales, again, not great. 2020, it almost reached my threshold of 5% at 4.84%. But I look for 5% on a consistent basis. So let's say most of the last decade, and it does not suppress that. Decent amount of cash. So intangibles make up a huge part of their balance sheet, which intangibles and goodwill typically come from acquisitions. So again, when we get to the balance sheet, we'll talk about that. But they make up a huge percentage of their book value, 63.22%. Most likely is not a good thing. I'll tell you why when we get there, just after I confirm what my suspicions are. They do have a decent amount of debt. 28% of their balance sheet is in debt. Their liabilities as a total are low, though, compared to their overall balance sheet strength. Again, with the caveat when we get to the actual balance sheet. Okay, I've talked about cash conversion cycle a lot in the last few videos. I'm looking on my other screen here real quick so you can reference them. Zora, Z-U-O is the ticker. Tattooed Chef, I think I talked about it. I think I talked about the cash conversion cycle in both of those videos. So if you want to reference those, you can find those in the links below this. And I'll more fully recommend, or not recommend, explain cash conversion cycle there, because this has gone up and down a lot, and frankly, with their business model, I'm not sure how much this affects them. So, but it is important that it has gone down. I'm just not sure to what degree, frankly, because the business model and the long-term rate of these kinds of things in the medical arena. Okay, interest coverage, negative 10.7%. I've talked about this in a lot of the earlier videos. I think on Cody I talked about this, and some others. Again, you can find those at the link below this to go to our other videos in this series. When this is negative, it's not a good thing. It means the company cannot pay their current interest payments on their debt with operating profits. It can't do that because obviously it's unprofitable on an operating profit basis. So how does it continue operating and paying debt? It's been issuing shares and most likely has been issuing some debt as well, which we'll see in a minute. But when this is negative, it means the company cannot pay for their current interest payments on their debt with current operations. So they have to raise funds elsewhere. That is typically from selling shares and selling debt, and neither are great. They have been issuing debt. I can see right here already, but let's go to the actual balance sheet. Okay, so they have, what's the size of the company again? 18.6 billion. They have 1.38 billion in cash equivalents, and short-term investments. Okay. So here's where we get to the interesting stuff. So it said they've acquired businesses. Looks like they've done it multiple times. Because just in the last year, it's gone up from 1.24 billion in quarter 1 2020 to 2.18 billion dollars. So it looks like they most likely closed on another acquisition in the first quarter of 2021. Goodwill is essentially useless 99% of the time on a balance sheet. It is, again, 99% of the time, specifically only an accounting number, meaning it has no economic value on the company's profits, operations, anything, frankly, even valuation, other than what I'm about to talk about when it comes to book value in 99% of cases. Goodwill. So what is goodwill, you might be asking? Goodwill is the excess value a company pays over the book value when it acquires a company. So let's say it buys a company for $1 billion, or let's say a company has a book value worth of $1 billion and Exact Sciences buys it for $2 billion. It would get a $1 billion goodwill, or it would increase its goodwill by $1 billion after the acquisition, which is kind of pretty close to what it did here. That is simply what it is. So it has no bearing on economics of the company most of the time. Because of that, I would discount pretty much 100% of this value off the balance sheet. When I do the valuation, when I do the actual balance sheet valuation, the net current asset valuation, I would discount pretty much 100% of this value off the balance sheet. So that would lower their book value by about $2.2 billion, rounded up. I would also, actually, I wouldn't discount pretty much hardly any of these other assets because they are trademarks, patents, software and technology, research and development, customer relationships, other intangible assets. So these are actually do have some value. So I would keep about, about half of the value of their quote-unquote intangible assets, including goodwill. But doing that would lower the book value of the company by, used to be at the bottom, and is it not anymore, by, about 60%, because their total book value right now is their total shareholders' equity, or total equity attributable to parent stockholders, I'm assuming what that says. They keep changing the wording on Morningstar here. So that would lower their book value by about 60%, which would lower their book value per share by about 60%, which would lower their growth per share over the last decade by about 60%. That's why I said there's a caveat here, or there's likely to be a caveat here, because I saw that they acquired a business, because I knew that was most likely going to lead to increases in goodwill. And when I do valuations, that's not a real world economic value in, again, 99% of cases. If the company has huge competitive advantages, like gigantic competitive advantages, we're thinking like Coke's, Amazon's, Apple's of the world, the goodwill for them has some value. For most 99% of the other companies on earth, has pretty much no value. So I would subtract that from the valuation, the net current asset valuation, which would lower the book value, by about 60%, which will lower the book value per share by about 60%. Are they still growing the value of the company over time? Yes, but it's not as drastic as it first appears. So 21. So that would lower the book value per share to about, I'm just going to do it on my calculator, 21.27 times. That would lower it to about $8.50 per share. Again, huge growth rate, almost an 8x growth rate from last decade, but it's not the 2021 almost x valuation from the last decade. That's why knowing this kind of stuff is so important, because it allows you to automatically see, just by reading this information down here about them buying the company, going over here and seeing the increase in the book value, and then over here on the financial health sheet, seeing their huge increase in their intangibles as a percentage of their balance sheet, I knew that most likely they would have a huge amount of goodwill. And again, that lowers, I would discount that, or I discount that for pretty much every company I look at, and that lowers the valuation overall of the company. I hope that makes sense, because it's a very important point. If it doesn't, let me know in the comments below. Nothing else of major note there. Let's go to the cash flow statement to see where they're raising some of their cash from operations, or cash since they're not profitable from operations. I know some of it is from selling shares. And we did not look at debt. I'm assuming that has gone up. Let's go back to the balance sheet real quick. Long-term debt has gone up by about 380 million-ish in the last year. Current debt has gone up as well by about 300 million. So yeah, they've added debt as well. So let's go see that on the cash flow statement. I'm just scanning through here to see if there's anything else I see that I want to talk about. Not really. Total issuances, repayments of debt, proceeds from issuance of long-term debt. In the last year, they've issued about $1.13 billion in Q1 2020, which again is not uncommon because that's when COVID hit and companies were freaking out and they're trying to raise as much cash as possible. So that's not uncommon. Where is the issuances of the shares? Okay, so but it's only showing in the last year. They haven't issued shares, it doesn't look like. Let's see. Let's go to the annual number and look. Okay, there's more issuances of debt. Where is... I'm not seeing it on here. When was the last time they issued shares? So they have issued shares in the last 5 years. I'm not seeing it on here. Again, Morningstar keeps moving stuff around, so I apologize for that. It's taking me a little bit longer to find it. There we go. Total issuances of payments for common stock. So they have issued some stock, but they've actually raised more cash from issuing debt in the last 5 years. Again, neither is optimal. I'm not going to say it's bad because if the companies use the capital well, then it can be a good thing. In this case, it's what I would say is if this was a quote unquote normal company, I would say they're definitely not. They're definitely not investing their capital well because their ROICs, free cash flow to sales, all those margins are hugely negative. There's a caveat again, because this company is built on such a long-term outlook and prospect. Precision medicine is relatively new still. It's probably still too early to tell if they are investing their capital well in buying these assets, stuff like that. However, I would say that because of their massive amount of goodwill, there's a high likelihood that they are not using their capital well because they're most likely overpaying. Remember, goodwill is the amount in excess you pay based on the company's book value. Yes, I know book value doesn't mean as much. I realize that, but it still should be somewhat decent. Or if it's not, you should be buying profitable assets that are generating revenue, cash flows, stuff like that now or in the relatively near future. So far, that hasn't panned out for Exact Sciences. Again, I know that this is a long-term prospect. That's what they're going to say, which is good. But at some point, the company has to earn profits. Okay, here's where we get to the typically not so fun stuff for these companies that I look at is the valuations being insane. Their PE First off, I don't care much for PE, price to cash flow, forward PE, but when I do, I want it to be under 20. PE is unreadable because it's unprofitable on a net income basis. Price to cash flow is 155, which is insane. Forward PE, again, is not readable because they aren't expected to earn profits in the near term future, and I can't look at enterprise value to EBIT because the company has negative operating profits as well. So let's do what I've showed you a couple times now. Find a company of similar sizes or similar size and compare them to show you or to illustrate to you how unprofitable or how overvalued, this company is. I see AMC is up again today. Shocker. Stay away from that, by the way, if you're any kind of long-term investor. Yeah, I don't want any part of those games. I made a video about AMC that you can watch on that. I'll probably make another one as well. Okay, so what I do here is sort by market cap, find a company of a similar size. 18.6 is, I think, what it was. 18.6. Let's not go with the REIT because those are evaluated differently. Let's go with Akamai. Okay. Are they profitable? They are. Good. So I can illustrate the valuation here. Before I do that, let's go to that. Let's go to that. Okay. Again, I've showed you this in several videos, which you could see at the other videos at the link below for free. Akamai, well, again, hopefully I'm pronouncing that right, has a revenue of about $3.3 billion rounded up in the last 12 months. Exact Sciences has revenue of about $1.6 billion. Operating income. Akamai has $730 million rounded up in operating profits. Exact Sciences has lost almost $800 million. So that's a difference of about $1.5, $1.6 billion in Akamai's favor. Net income, $590 million for Akamai. Loss of $750 million rounded up for Exact Sciences. Free cash flow, $560 million positive for Akamai in the last 12 months. $45 million in free cash flow in the last 12 months for Exact Sciences, and most of that, or actually all of that, is from issuances of shares and issuances of debt. Without that, this number would be negative as well. So what this illustrates is that Akamai has 2+ X higher revenue and a difference of about $1.5 billion in operating income, similar amounts for net income, and about $500+ million difference in free cash flow. And yet they are valued in terms of the market cap at about the same rate. Over the long term, this is important because over the long term, companies are valued based on the profits and the cash flows they produce over the long term. Oops. I said I don't care mostly for PE and price cash flow and forward PE, but again, let's keep going with this exercise so you can see how overvalued Exact Sciences is. On PE, price cash flow, forward PE, again, I don't care about them much, but I look for anything under 20. Akamai's is 32, its PE is 32, its price to cash flow is 15.2, its forward PE is 20.8. This is the most important number though, the EV to EBIT, enterprise value to EBIT. I look for anything below 8 here on this metric, and this is at 28.1. So this shows that Akamai is by a large margin overvalued, yet it has the same market cap as Exact Sciences, and Exact Sciences is far smaller and far more unprofitable, or far less profitable and actually unprofitable than Akamai. So that means if Akamai is overvalued, that means Exact Sciences is enormously overvalued. I wouldn't have invested in this company bring my face back here. I wouldn't recommend investing in Exact Sciences without the valuation, or just based on its numbers. I mean, I would have said it doesn't meet my threshold for what I look for my investors. So I would have said it doesn't meet my investment criteria, and I wouldn't invest in it, or excuse me, research it further after that because of the valuation. There's no way. Again, I don't care about the story. I don't care what they're planning on doing. I don't care about any of that until and unless the company meets my minimum criteria right now today. And right now today, Exact Sciences doesn't meet really any of my criteria. From the numbers perspective, from the interest perspective, from the personal perspective, I love this kind of stuff. Find it super interesting. It's coming. It's going to transform the world. Truly believe that. But right now today, I can't invest in Exact Sciences because they're massively overvalued. They're unprofitable. All the things I look for. Again, I don't think it surpassed any of my criteria, and I'm thinking about it. So I hope this helped. Hope you found this interesting. If I didn't explain something well enough, if I should explain something better, let me know in the comments below. This was again for Ethan the Warender. Hopefully I'm pronouncing that right. Thank you. Great case study here. Thanks for watching. Thanks for commenting. If you want me to look at a stock anywhere in the world, I will do so. Anywhere in the world. Again, for the last 3-4 months, every stock I've looked at is recommended from a YouTube commenter. If you want me to look at a stock for you, I'll do so anywhere in the world. The only caveat is it can't be a bank because I don't evaluate banks. It can't be an insurance company because you actually have to dig into the financials to the 10K and the annual report for that. And it has to be generating revenue. Why does it have to be generating some revenue? Because I evaluated some companies that were generating revenue for viewers, and frankly it was kind of boring because there was nothing to analyze. So if it meets those 3 criteria, let me know. I'd love to look up, research a stock for you, analyze the stock for you. Again, anywhere in the world for free. If you're listening on YouTube, thank you so much. Really appreciate it. Also make sure to like, love, share, subscribe, comment, all that good stuff. If you do subscribe, hit the notification bell so you're notified every time we release a new video, and release new videos all the time. Same stuff on the podcast. Really appreciate it. But on the podcast, we'd also really appreciate a review, because the more reviews, views, and listens we get on our content, the more people we can help. If you're looking for more specific help from me, or if you're looking for more specific help on how to become a better investor faster, you can get my full preliminary analysis checklist, the actual hard version of it, so you can do this kind of analysis yourself at the link below at the 5 free gifts. You can also get a free PDF copy of my book, How to Value Invest, and you can also get a copy of our guide, 7 Tips to Picking Great Stocks, 3 Times You Must Sell. You can get all 3 of those for free at the links below. If you're looking for more help from me, specifically from me on how to become a better investor faster, make sure to check out the information from our masterclass below this as well in the links below. But until next time, have a great day. Talk soon. Bye.